Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. We're joined today by Dr. Ed Yardeni, one of Wall Street's most respected voices on the economy and markets. Dr. Yardeni is the president of Yardeni Research, a leading provider of global investment strategies and asset allocation insights. Ed has had a very distinguished 40-year plus career on Wall Street, primarily as a chief investment strategist. In addition, he's held positions at the Federal Reserve Bank of New York, Federal Reserve Board of Governors, and the U.S. Treasury Department. Welcome to the podcast, Ed. It's a pleasure to have you.
Thank you, Gary.
Ed, you've seen a number of economic cycles over your career. What, if anything, feels different about this one?
Well, we really haven't had any real problems in the credit markets. Usually, when the Fed raises interest rates the way it did until last year, we saw that something would break in the financial system. There'd be a financial crisis, which would then lead to an economy-wide credit crunch, and that would cause a recession. As you know, for the past 3 years or so, we've had the most widely anticipated recession that never happened,
Right.
and that's partly because of the resilience of the capital markets. I think the banking system is much firmer ground now than it was obviously around the great financial crisis. We made a lot of progress there. There are a lot of kind of safety nets and shock absorbers in the credit markets, and as a result of that, we haven't seen a credit-induced recession, and instead, the resilience of the economy has been quite remarkable. We've had what I would call some rolling recessions. Housing clearly has been in a recession. Office buildings and downtowns are obviously in a recession. But capital spending, particularly on technology, including AI, of course, has been very strong. And the consumer has continued to spend, even though lower income consumers obviously are getting stressed. There are a lot of older Americans, baby boomers, who are retiring, and they're retiring with a collective net worth of $80 trillion, and the stock market keeps going up. So they go on their cruises, spend a lot of money, and then they come back home and look at their account, and they're still got the same net worth or more.
Right. That's great. Lots of headlines to potentially impact the market as we head into the fourth quarter. First up, the Fed meeting this week and the expectation that interest rates may begin to be lowered. What do you think the Fed's path looks like beyond this meeting and over the next 6 to 12 months?
Hard to say because the economy is doing relatively well. I mean, real GDP increased 3.3% in the second quarter, and it's on track right now, according to the Atlanta Fed's tracking model. It's on track to increase 3.1% in the third quarter. The unemployment rate is 4.3%. Inflation is closer to 3% than 2%. So Gary, remind me why the Fed is lowering rates when the stock market's at an all-time record high, gold is at an all-time record high, Bitcoin is near an all-time record high, and yet the Fed, for some reason, feels that the Fed funds rate is too restrictive. I think they're responding, obviously, to the weak labor market data, and I think the labor market's very hard to interpret. It's very funky. We had this huge inflow of migrant workers, and now that's stopped. And then we've got deportations going on. Some of the areas where jobs are weakest are actually state and local governments. And the Fed really doesn't need to lower interest rates now. So what's the big deal if they do? Only that we might get the financial instability. We might get a 1990 style melt up. Valuations are already pretty close to where they were in 1999. I'd like to see this bear market last through the end of the decade because I've been talking about the roaring 2020s since 2020, and
Right.
now I'm talking about also the roaring 2030s.
I mean, do you think that given the strength in the markets that you alluded to, that the price cut is already baked in, basically? Is what I mean,
Yeah,
yeah.
yeah, I think it is, but I think it's important to realize that what's really driven this bull market, and I'm really starting this bull market after the sell-off, the bear market we had not in 2022, but really in 2020. Back then, we had a 2 month recession because of the pandemic lockdowns. Market took a dive. The Fed came in on March 23rd, 2020, provided an enormous amount of liquidity. The market recovered to where it had been a few months later. And from that point, from the recovery point to where we are today, the market's up 100%. The S&P 500 is up 100%. And guess what? Earnings are up 100%. The valuation multiple actually was around 22 back then, and here it is back at 22. It's obviously hasn't stayed here. It's been kind of volatile. Got down to 18 when the market sold off in October of 2022 when it hit a bottom there. But there was no recession in 2022. There was a very short recession in the pandemic experience. And so when I look at it from that perspective, it seems to me that what's been driving this market higher has been something very powerful, and that's earnings. And earnings have once again this year proven to be remarkably resilient, much better than expected in the first and second quarter, much better than expected by the consensus. And that's in the face of all the turmoil created by Washington's policies on tariffs, on employment in the government, and so on.
Yeah, you hit on another potential headline, what's been a headline subject, tariffs. How do you see their impact over the next year, and what effect, if any, could it have on Fed thinking in the stock market?
Yeah, I think the market's kind of concluded that it's the problem's behind us, and that it wasn't such a big deal because tariffs, one way or the other, have to be paid by either the companies that export to us, or by importers, or by the consumer. And there has been an impact on the consumer. Durable goods inflation typically is negative. We usually have falling durable goods prices because of productivity. We're now seeing that there's been a recent uptick in durable goods inflation back to slightly positive readings. Nothing terrible, but that is an indication that tariffs have had some impact on inflation. But other areas have remain relatively moderate. I think what tariffs have done is they've kept the inflation rate from falling down to 2%. I think it's kind of got sticky, got stuck around 3%, partly because of the tariffs, and partly because maybe, people are reckoning that monetary policy, fiscal policy are going to be inflationary, and so we are seeing some inflationary pressure still in the services sector. So that's kind of the way I'm looking at it.
And are you concerned at all about the long-term sustainability of U.S. fiscal policy?
Absolutely, like everybody else, and we now have we got three poster trails now around the world. France has a debt crisis, a political crisis. The UK, same thing, debt crisis, political crisis, and Japan, the same story. I think the bond vigilantes, a phrase I coined back in 1983, are they've kind of gone on vacation of late to France, the UK, and Japan, and they don't like what they're seeing there, and they push bond yields higher. Here in the United States, there was a lot of anxiety about a debt crisis only a few months ago, and now that's all calmed down as the bond yield has come back down to 4%. And I think that's because the bond market is keying off the Fed lowering rates. But we have to be still concerned that the bond market at some point, the bond vigilantes could return here and start to indicate by pushing bond yields higher that our deficit issue isn't really being solved. Look, I think the Trump administration came up with a clever way to raise hundreds of billions of dollars in tax revenues, and that was with tariffs. And it looks like it's at an annual rate bringing in maybe $400 billion, which is substantial, and that helped to calm the bond market down. But wouldn't you know it, we're not sure that those tariffs are legal. They may not be consistent with the powers that the president has according to the Constitution. So the Supreme Court is going to rule on that. And the administration said, that this could be a disaster if the president said that. Don't remember his exact words, but basically he said it would be a disaster if the courts ruled against his power to impose tariffs. But then again, the administration has also said they have alternative ways of doing the same thing, but it's not quite as easy. So I think the market's fairly complacent about these tariffs. I think they are having a pretty significant negative impact on the rest of the world. We just got some data for China. China's economy is slowing, At the same time, we know that China's economy is vitally important to the rest of the world, particularly emerging economies. And so they're getting some impact of the slowing of China's economy because of possibly to a certain extent because of the tariffs. But China's economy's got some other issues for sure, like a property bubble that burst and remains a major source of a negative wealth effect. But other emerging markets have been slapped with Brazil, Indonesia. They've been hit with high tariffs, and they're kind of struggling with that. So there could be some global implications that affect our businesses that export to the rest of the world.
And how about the markets themselves? What's your outlook for corporate earnings and stock market performance?
Well, pretty straightforward. I think next year S&P 500 earnings will be $300 per share. When I do PE times Z, I kind of anticipate what analyst consensus will be for earnings. So if I'm right that it's going to be $300 a share, I think I'm kind of using that as the number that analysts will be anticipating at the end of the year. And right now they're expecting $304 a share. So we're right in the right neighborhood. By the end of the year, you take $300 per share for next year and multiply it by 22, which is where the forward PE is right now, and you get 6,600, which is basically where we are right now. But I've been very bullish. I've been very optimistic on the economy, and much to my surprise, earnings are better than even I thought. And
Right,
it's
right.
conceivable that our earnings are going to continue to rise here. In which case we could be looking at something like 6,800, and we could be looking at something even more than that if the valuation multiple moves higher because the Fed continues to lower rates. For the end of next year, I think analysts and myself will be looking for $350 a share. Put 22 on that, and you get 7,700 as a target for next year. In other words, the market will be anticipating increasingly what's happened in 2027. Look, the bottom line is this is a bull market. Corrections, even bear markets that might be ahead here. I think we'll be buying opportunities. We may not have any corrections or bear market for the rest of the decade because we've kind of gotten bored with that. We've already had that a few times, and
Right.
it didn't really occur. So I'm looking for at least 10,000 on the S&P 500 by the end of the decade.
Wow. Okay. And even within that outlook, how do you see sector leadership? Does tech keep dominating, or are there very significant opportunities in other sectors?
Yeah, well, maybe I'm lazy and I'm just sticking with what's been working for me, but it's worked remarkably well since October of 2022, and honestly, since the beginning of what I view as the beginning of the bull market back in 2020. I think I've been recommending overweighting information technology, communication services, industrials, and financials, and they've all been at the top of the leaderboard. They've all been phenomenal performers, outperformers. I also did recommend energy, which was a clunker, and I gave up on that last year. But I'm sticking with those. We've been particularly pounding the table on financials. I mean, we're sort of like in the sweet spot of the bull market where, we're at record highs. It's getting easier and easier to do IPOs and mergers and acquisitions. So that's what we're doing. And that means the financials are generating more and more earnings doing those kind of deals. And the financials keep going up into new record high territory. And everybody knows that, if you want a good, strong, solid, sustainable bull market, the financials have to be in the leadership here. And that's where they are right now. So that's kind of feeding on itself. And then the whole AI technology idea is feeding on itself, as we just saw with Oracle. What we just learned with Oracle is that, maybe the people who sell the AI models for $20 a month aren't going to make a fortune, but they are going to create a lot of demand for more cloud computing, more cloud storage. And so the cloud investment ID, which really took off with 2011 with the cloud really proliferating, that's kind of feeding on itself as well. Because if you think about it, we're sort of in a digital revolution, and in this digital revolution, it's all about processing more data at a faster pace and more cheaply. And as we do that, guess what? We come up with more data to process, especially if the price of doing so goes down. So it's definitely feeding on itself.
Right. And what about geopolitical tensions? U.S. China, war in Ukraine, Middle East conflicts. How do you factor this into your outlook, and how should
Yeah.
investors consider that factor in their own investment thinking?
Well, the world has always been a dangerous place. We've learned over the years that geopolitical crises actually create buying opportunities rather than reasons to panic out. I think back, was it in maybe in 42? I think I got the years just about right. We succeeded in Midway, and the stock market bottomed, and that the markets started to get a sense that after Pearl Harbor, we really were going to make a comeback pretty quick with our ability to knock out the Japanese Navy in Midway. And so, we saw with the Middle East crisis, the market really held up remarkably well in the face of Iran launching missiles at Israel, and then of course Israel retaliating, and then we've got the Russia-Ukraine war, which contributed to the bear market in 2022 because oil prices spiked and there was a lot of concerns about shortages of grain and so on. And we got through that with the market actually at some point looking at that as not the kind of news to really worry about. But the geopolitical situation is pretty awful. Russia, Ukraine is awful. Russians playing games with us with drones over Poland. That's bad. Uh, I guess we have to worry about China and Taiwan. There's a lot of things to worry about, but it's all about PE times E, and the E is really good. And the if you're worried about if the market's worrying about geopolitical risk, you'd see it in the PE, but PE's very elevated, so that's not the case.
And in your view, are there any other catalysts that market participants should focus on, or potential triggers for a correction or upside that you don't think are fully appreciated today?
Well, I think back in 2020, if we were thinking about 2026, we'd be thinking that not much is going to happen. We'll get through the pandemic, but the technology revolution is really ongoing. And if you go back and think about how you thought about the future in 2000, well, here we are. This is the future, 2026. And it looks like a lot of the science fiction ideas that were out there that motivated Elon Musk to actually make some of these things practical realities. And then NVIDIA came up with chips that, have dramatically accelerated the digital revolution in terms of being able to process more and more information. So robotics is around the corner. Autonomous driving is around the corner. That in turn is, with hybrid cars now, we've and electric cars, we've seen oil prices coming down to levels that are very affordable for most people. And you know, I think you have to look at what's going on in the technology world. There's already some scuttlebutt about fusion and energy becoming a more realistic alternative to what we have now. So I think technology is always the big surprise, and I think it's it should be less surprising now because it's so much in the headlines.
Right. We've touched on the Fed, market drivers, and forecasts. Can you given these factors, how would you advise investors to position themselves? What's the right mix between equities, bonds, and alternatives?
Well, I think what we're learning over and over again is that stocks are meant to be held for the long run. You should earn your dividends. You should reinvest them in the stock market. Uh, Trying to day trade is, some people make a lot of money doing that, but that's a full-time job and requires a certain skill and a certain psyche to be able to withstand the stresses. But all in all, I think that from the perspective of a long-term investor, you could just buy the S&P 500 here. You could buy, if you want to be more aggressive, you could buy the Nasdaq. You could there's a lot of ETFs now that allow you to invest in data centers as an investment theme. But I would stay with technology. Maybe now you look for some cheaper stocks in the small and mid cap arena, the S&P 400 and the S&P 600, mid caps and small caps. Um, Financials still look just fine. Regional banks maybe have been laggards. Maybe they'll do some catching up here, but there's a lot of fintech going on here that is likely to significantly cut the cost of business for banks. Stablecoin is an interesting idea. The Genius Act has permitted stablecoins to exist, and they have to be backed by treasury bills. But imagine that we don't have checks anymore, and that everything is cleared immediately. You don't have to really imagine it. We all know about Zelle and Venmo, but stablecoin basically will allow that to impact all financial transactions. The financial consequences should be lowering costs, and the companies that adopt these technologies should benefit. But it could also make it a very competitive financial market, so that's something to be aware of. So a lot of interesting developments. That's for sure.
Okay, great. There's also been a fair amount of debate around the classic sort of 60-40 portfolio. How relevant do you still think that is? And do you think it works, or is it time to rethink that framework?
Well, I'm inclined to think that at best you're going to earn the bond yield a coupon. I'm not a believer that the bond yield is going to come down, even if the Fed lowers rates. As we saw in 2023, we had the Fed. I'm sorry, as we saw in 2024, how time flies when you're having fun. But in 2024, the Fed was expected to lower rates. They did. During the expectations period, bond yields came down. But when they actually lowered rates by 100 basis points, guess what? The bond yield went up 100 basis points. Mortgage rates went up 100 basis points because the bond market wasn't convinced that the easing made sense when the inflation rate wasn't down to 2%. Deficits were still huge. And so I'm not convinced that bonds are going to be all that attractive relative to stocks.
Okay, great. You touched on it before, AI. Could continued AI adoption and penetration change how we measure things like productivity or even GDP?
AI is very controversial. It's definitely artificial and it's not intelligent. What it is it's kind of like Google search on speed. It's kind of like autofill on speed, speed and steroids. It does things a lot faster that we've kind of did almost manually. When you be typing on Word and the autofill tells you what the next word should be, at some point it's more annoying than it's worth, so you kind of ignore it. That'll be sort of the challenge for AI. I've been using it quite a bit as a research assistant. Instead of having to go through Google and then read every single article, basically what AI does for me as a research assistant is it summarizes all the articles that are relevant to what I want. And then I can read it. And then you really have to check the sources because I haven't had any situations with hallucinations. My program hasn't told me that it has deep affection for me yet. Uh,
Right.
but I have had a debate with one of these chat things that about what date something actually occurred, and we kept kind of going back and forth, and it kept changing its mind. So, oh, you're right, it's that date, and then before you know it, it interrupted me and came back. No, it was that date. It was kind of bizarre. So I think if you use your own data or vetted data and apply it to use the AI models, I think you'll be fine. You'll actually get productivity out of it. But don't use data that's off the internet because it's going to be garbage in, garbage out. And so it's still a work in process. I am amazed by the conversations you can have with it, but I don't know the extent to which at some point I'll just get bored with it and conclude that it's not so smart after all. Uh, and all we'll be left with is sort of the negative social consequences that people talking to AI might get. You know, AI may have hallucinations, and the people they deal with might start getting hallucinations. We've heard some cases of that.
Are there other innovations though out there that excite you more than AI, or just you're
Well,
enthusiastic about?
I think let's reverse engineer this and see what's really motivating productivity, and that is a shortage of labor. There's a shortage of skilled labor. A lot of kids coming out of schools with very similar degrees and similar subjects that aren't particularly needed. And as a result of that, we are seeing that yeah, young kids coming out of college are having a tough time finding jobs because there's the skills they learned are a mismatch with what's available. And then, of course, we've had this shutting off of the southern border, the deportations. Baby boomers retiring is a big thing. You know, a lot of very experienced, productive people are saying, you know what, I'm going on a cruise. I don't want to work anymore, and they're hard to replace because who are you going to replace somebody who's had years of experience? And so I think what we're seeing is companies using whatever technology they can, whatever management rethink they can to increase the productivity of their workers. And I think we're seeing that panning out. Recently, we've seen some weak employment numbers. And employment, there's a supply side and the demand side, and the weak employment numbers are partly because of weak demand and partly because of shortage of supply. On the weak demand side, by the way, state and local governments have really cut back their job openings. And I think a lot of that has to do with the migration. When migrants were streaming across the borders, states were scrambling to get teachers and they were scrambling to get social workers. And now that's all kind of reversed. But I think that productivity is partly based on on technology and partly based on just recognizing that the businesses are saying they got to be a better way to do this in an environment where it's hard to get workers. We got to make our workers smarter, augment their productivity, and I think that's what you're saying.
Right. We've covered a lot of territory here in a very short period of time. When you step back and look at investment frameworks, outlooks, they're not really created in a vacuum. If you could leave our listeners with some thoughts or principles for navigating uncertainty and being able to filter out the occasional noise in the markets, what would it be?
Well, I got a good one for you. I've been doing this for a while, and one of the insights I think that I've come to that's worked quite well for me over the past several years is that it's amazing how well the U.S. economy and stock market do despite Washington. I think a lot of people are missing some really good opportunities in business and in the stock market because they don't like what's coming out of Washington. And it doesn't matter whether we're talking about Democrats or Republicans. There's a lot not to like about what both parties have been doing when they've had control of the government. And yet, despite that, look how well the economy is doing, all-time record high for GDP, real consumption per household, all-time record high, stock market, all-time record high. And I think that speaks to the resilience of the economy. It speaks to the fact that there's Washington and then the rest of us working stiffs that go to work and try to figure out how to navigate the policies and make things better for ourselves, our families, our businesses, our communities, our country. And we do it really well. There's 30 million proprietorships in America. These are proprietorships. They're self-owned. I'm a proprietorship in my business, and we're very motivated to make things better, to grow our businesses, And so I think we're just an example of that. Also, we've got some really amazingly well managed companies. I mean, we have the Magnificent Seven. You're not going to find too many companies out there that in the rest of the world that fit the bill. Maybe now we need to add Oracle as the Magnificent Eight, but we've got some really magnificent companies.
Ed, thank you for joining us and for sharing your insights and perspectives on the economy, markets, and policy.
Sure.
And thanks to our listeners for spending time with us on the Compound Insights podcast. I'm Gary Farber. We look forward to bringing you more conversations with leading voices in finance, and we will see you again soon.